usual. So just first things first, the existing SPY position. Again, I was just having a chat offline with Stephen there, just saying, like, you know, why this strategy works. It's simply this arrow here is the best explanation. You can make money in 3 different directions. It can go this way, it can go that way, and then it can go that way, as long as it doesn't fall below here. So you're just putting so many odds in your favor. And now that trade has got a 99% chance of winning. So it's just consistent. And when you're doing it with something like SPY, so I just wanted to clarify that, you know, if you do that with an individual equity, you could have a situation like what you have with Meta now, for example. So, you know, you're not going to get that type of a fall off in SPY. It's very unusual for that to happen, but it's quite common in individual equities. And that's why I call SPY being the statistical edge. Even doing it on currencies and even commodities to a degree, depending on where they're trading at. But SPY, certainly, there's 100 years of statistical data backing up why this strategy has a 90% chance or more of working, depending on what strike price you pick. So anyway, just jumping into the trade itself right now, markets are down a little bit, but we're still kind of up, what, $304 there at the moment. We've potential to make another 195. Now, I could let that run all the way to expiry, and you're 99% certain that that's going to eventually go to zero, and then that 195 will actually go into the profit column. Remember, we've sold the put, so we want the value to go to zero. Having said that, best practice is really when it gets to 75-80% of your max profit, walk away with SPY. If you were doing that in an individual equity, I'd be saying like 40 to 50%. But because it's SPY and we've such a high probability, we can leave it on a bit longer. So when that trade gets to roughly, let's call it 375 in profit to 400, I'll take that off the table. Okay. So is there any questions on that SPY trade or anything leading from it? So the question is, okay, reapplying it again. It's when's the next time? So see the VIX here. Anytime you see things like this, keep looking at the volatility index. So when you see the VIX spiking like that, then you can consider putting on your next one. So we're starting to move up slowly on the VIX again here. So I wouldn't be putting it on now, for example. It's not ready yet. But if we got a spike above 20 again on the VIX, then I would consider maybe opening up new contracts and bringing the strike price maybe closer to 640. So the little kind of scare we had here that brought it down is well and truly over. That's, you know, we were talking about different little bits and pieces here that was starting to go on. You know, the government shutdown we had going on. We had a lot of kind of scare tactics going out there about the AI trade. Personally, myself, the best we're going to hope for in a pullback in this is 5 to 10%, and then I think it grinds higher until we see the US economy falter, which we're not seeing at the moment. Okay.
Question, if I may.
Sorry.
Yeah, go ahead.
Would you put on the second trade, Stephen, with the first one still on?
Because it's at 620 the strike, yes. But if you were at 640, the answer would be no. So just to explain that again in simple terms, we've got such leeway. Like statistically, there's less than a 1% chance of SPY getting down to this level at this moment in time. Now that probability changes as the share price starts falling, right? But if we were at 640 there, it's still statistically like less than 10%. But I would be. It depends on what your current position is relative to your account. So let's say you're nowhere near your allocation, then I'd say, oh yeah, belt away. But if you're fully exposed, I wouldn't. I would take off the first one and put on the second one, if that makes sense, Pat.
Yes, it does, yeah.
Okay.
That was actually something similar to the question I was going to ask, as to if you were to let that run for, you know, till it's down to what, $100 or so, just to say left.
Yeah.
You know, there's $100 left in it. I mean, why not let it run? Are you just trying to reduce your exposure in case there's a wobble somewhere? Because it's probably at a strike where is it you know, and I'm not, the question, I don't think I'm phrasing correctly, but is it because, why not just leave it there and say, do you know what, it's 99, 98, whatever it is % chance of it working out
Yeah,
great for us.
would do.
Why not take the extra 100? Are you trying to free up capital ahead of your next trade? Is that what it is? Or what's the rationale? Is that, okay, great.
That's exactly it. You've answered your own question there. It's really to free up capital to go again. So for example, if we're, let's say, 2 weeks to expiry, right, there's this is where you start getting into the Greeks, and I'm not going to complicate it for people, but your gamma risk goes up, but not with something that's so far out of the money like we have. So we don't have a lot of gamma risk, right? But if this was closer, then we'd have what we call gamma risk, and then you certainly would be saying to people, time to close that one down and open up the next month and reduce your gamma risk. So what's working for us at the moment is time decay, right? And the closer we get to expiry, the time decay speeds up, which is great for us. So you're absolutely 100% correct. There's nothing wrong with something like SPY, right? Leaving it till expiry. But if you looked at our previous examples, at times, if we'd actually closed out at 75 or 80% of max profit, we would have got another opportunity to re-enter the trade and generate more premium. So, for example, let's say we close the trade down today and the next 3 days, SPY does this, has a bit of a wobble. We would have been able to reapply that trade and generate even more premium than what we paid out to buy it back. That makes sense. So it's really freeing up that capital to be able to go again. But having said all of that, Stephen, everyone is different, and there would be nothing wrong with your mindset on this to let it run all the way to expiry with SPY. Now, I'm talking about SPY. If it was an individual equity, I'd say no, unless you wanted to get assigned that stock. That's different. So just again, to remind people, there's 2 ways of looking at the short put strategy. There's one is the return-based strategy, and that's where you've absolutely no intention of taking assignment to the shares. And the second one is you want to actually get the shares. So that's the only time I would say to people with stocks, let it run to expiry. But other than that, get it off when you're in 40 or 50% profit, because you can have a meta on you where the thing is down 20% since earnings. That can happen, and you don't want to be in that position. So, but with SPY, Stephen, just to summarize, nothing wrong with your school of thought there. If you want to let that run, let it run. All I'm doing is freeing up capital to go again.
Yeah, fair enough. That's clear as a bell. Thank you very much.
Okay, no problem at all. And while I'm talking about Meta, while I'm on it, we're going to buy that in the long-term portfolio soon. So I'll just go into Equity Scan here and show you. I'll have to refresh. Sorry, it's probably timed out now. So we look at Meta here. You can see the target price from the analysts at 839. We're at 766, which is 25% higher. So there's probably another, when the sentiment shifts, that probably is a little bit on the low side, this target that we have. And you can see our PE multiples isn't huge. It's not a significant, massive multiple we've used. And we brought down the price to sales. That normally, in the past 5 years, that's traded at 10 times price to sales. We brought it down to 8. So we're being a bit conservative versus the analysts. But even being conservative, that potential upside is based on this number here. And with Meta being at 609, I think it's good value here. So we'll probably look to buy Meta either today or tomorrow. So just thought we'd mention that while we're there. Okay. You can see it's been absolutely decimated since earnings. And I've explained in previous videos, I'm not going to go over it again. Basically, market doesn't like their CAPEX spend. That's it at the moment on AI. So that's why you're seeing this, okay? So just
ask.
Go ahead, Stephen.
Sorry, I don't mean to interrupt you, but I mean, what's the trigger for buying today or tomorrow? Is this, what are you looking for today?
It's just a sign to me that this downtrend is over. So do you see the way that low now? If you look at that chart right in front of you, about 4 days ago there was a spike lower. I don't know if you can see that.
I can, of course, yeah. Yeah, just out there. Yeah, okay. See,
I'm waiting to see, does that get taken out? And if that gets taken out, I'll just wait a little bit longer. So I'm really trying to use the charts to bottom fish now. So I'm happy with the fundamentals. I'm just really trying to say, look, is this downtrend over? You know, that was our first sign it was over. Now we're coming to test it again. That's all I'm waiting on.
All right. Fair enough then. Okay.
Okay.
Yep. Yep. All right. And I mean, insofar as allocations, the usual 5% average in, take a piece now, take a piece in a day or two. See which way the wind's blowing.
Correct. You can decide if you wanted to allocate your full 5% now, go for it. I don't see an issue with it. But if you wanted to go 2.5%, then 2.5%, just in case, you know, what I'd say is like this wouldn't be out of the question down here, 500 either. And that's a 6, like it's a 16% drop from where you're going to get in on it, you know. So I'm just saying that when this gets unloved, the market sells off hard. So on it, like, so if you look at that sell off from here to here, that's like 35% before it made a new high. So, you know, don't think for 1 minute Meta can't go down more. It can. And 35% lower here, for example, is at 520. You know, so just be aware of that. That's a possibility. It's happened over and over to this stock. It's one of those, when they love it, and when they don't like it, they tend to hate it, you know.
Gotcha.
Okay.
Thank you.
No problem, Stephen. No problem at all. So that's Meta. I suppose the other thing I want to focus in on, because it's the next trade up, really, is crude oil. And I'm just going to show you, and again, I'll introduce kind of the tax-free element for people who are in Ireland and the UK. But I'll show you both ways. And like that candle yesterday, that's a 4% drop. That really was down to OPEC. And basically OPEC came out and said that supply and demand are equal for next year, whereas before they were saying supply is lower than demand for forecast for next year. So obviously that's not good for the price of oil. And then I keep reminding people, and I won't apologize for reminding you, and I hope there is a ceasefire between the Ukraine and Russia. And if there is, I could see oil prices actually going down significantly then from there, because, you know, the expectation would have to be that Russian oil is going to come back on the market. Having said all of that, you know, if there's a lot of producers out there losing money producing oil, they're only going to do that for so long before they start cutting production. And I think that's eventually what's going to bring the equilibrium back and get us back to $70, $80 a barrel. So the question is, what way can you trade this? In my opinion, just because we're seeing this series of lower lows and lower highs, and that we've come down to this area before, in my opinion, the safest way is looking at the short put option on the futures. And whether you do that in Interactive Brokers or in something like IG Index is totally up to you, and really will depend whether you want to do it on a tax-free way or you want to, and if it's not relevant to you, well then use Interactive Brokers. So let me just jump into Interactive Brokers again and show you the trade I'm looking up. So the ticker symbol is CL, right? Now, if you have a smaller account, just type in MCL, and it's a micro version, okay, of that future we're looking at. It's basically the prices will be the same, but it's not a 1,000 multiplier, it's a shorter multiplier, which means that you're not going to be on the hook in case the trade goes belly up on you, okay? So I'm just going to use the main one though. I just wanted to show people how to do that, right? But I'm going to use CL, which is the main contract, okay? And each contract here, it's 1,000 multiplier. So if you pick a strike here, for example, of 53, it's 53,000 per contract. So for example, if crude oil then fell to 50, you're kind of down 3 grand on it. Just be aware of that, you know, minus the premium taken in. So that's why I'm waiting and trying to be patient and safer with this. So if we, for example, clicked on the 53 strike here, you can see the probability of profit at the moment is 90% of that. Our break even would be 52, 57. And then if you come down, the profit and loss tables aren't showing at the moment. But if you click on order here, I just want to show you, oh, my apologies. I want to show you, you can see your income here is 1,000 times the premium. So it's $430 a contract. So that's kind of roughly the ballpark area I'm looking at. If I bring it back to the chart, you'll see why I'm going down there. If I was to draw a line underneath this, just this support area here, you can see that's $55. So I'm trying to give myself more wiggle room just in case this starts taking a serious hit. And I still don't want to place this trade. I have a feeling we're going to make our way down to around this 57, 56 level. And it's kind of at that point I want to put the trade on. And the reason is the premiums are going to jump because the further it goes down. The volatility will be going up. Look at the IV index at the minute. It's at 33. So that's going to jump. And that's going to be to our benefit. We're going to get more premium in the door. Okay. So you just need to be aware of that. Another way of doing it, if you wanted to kind of do it in a, let's say, like through an ETF, you could do it and just trade the option chains on USO. So USO is an exchange traded fund that tracks futures prices on oil, right? So it moves something similar to it. So you could go out to something like December the 19th on that and go down and sell the 65 put, for example, and whatever price that's at. That's coming in at 89, just over 1%. You could go down to 63 or maybe 64, and that's roughly at 1% there. So you could do it that way either. In that way, if you did, you could actually take assignment here. And what would happen is you'll be in that trade for longer. So let's say oil plummets, you're going to be down on the position, but it's 100 times, it's 100 multiplier here. So it's 6,000 the contract as well. So that might be a safer way for some of you to do it. If you didn't fancy kind of managing the futures, if you were assigned the futures contract, okay? And then finally, the other way is through this platform here, which is IG Index. Now, this is only relevant to people in the UK and Ireland. You could actually spread bet the option, and that's tax-free. And I got clarification on that from IG Index yesterday. So just as a reminder for people, when you open up a spread betting account, you have a spread betting account and they give you an options account. The tax-free nature is only the options in the spread betting account. So I'm in a spread betting account now, okay? You're looking at the chart here of oil, and you can see I've drawn the three common denominators. So we could go to options. We could look at trading commodities, and we're looking at US crude oil. And if we come down here, we're looking at the January futures expiry, but it's the 16th of December expiry on the option. And the way this works is we would simply be placing a bet. So let's say we went down to 5,200 and we clicked on the sell price. We're basically betting, let's say we put down a $5 per point, right? We're betting 5 times whatever the sell price is, let's say $135, that oil is going to stay above 5,200. And if we win $135. $135. The margin set aside for this trade is 2,500. So it's quite small, the margin. It's only a 12K account, right? Now, if you wanted to up it, you could, but your margin goes up. And again, always remember, margin moves on these things as well. So you want to make sure your overall margin on this account doesn't get above 60%, because just in case the positions start moving against you, you don't want to be getting margin calls. So in this scenario here, we'd be getting 10 times 27.50. So the difference there's a big difference between the sell and the buy spread, as you can see here. That's them taking their pound of flesh off you at the beginning. Typical spread bets every night, if you leave them on, you're getting charged an overnight financing rate. With this option trade, you're not. What you pay now is this. So we would go straight into a loss on this trade because technically we went to buy it back immediately. You can see we're buying it back for a much heavier price, okay? And with this as well, if you do it this way, in the tax-free way, if it starts coming under pressure, you can roll this out and down like you do in interactive brokers. So, you know, this is up here at what, 5,900 at the moment. It's a high probability, as you know, it's over 90%. But I'll just remind you, it's not a guarantee either, okay? So have you any questions on that, folks? Is there anything you need me to clarify?
You have to set up an IG account for that, I take it.
You do, Pat, but you know what? It's much easier than interactive brokers. Once you're set up, you can deposit your funds by a credit card. and it's gone in instantly. And the great thing is when you're withdrawing funds, actually you can withdraw it instantly as well. So you literally go up here, add funds, and you literally just add your funds that way. Now that was a simulated account, so I'm after kicking myself out of it. But you would literally go and add your funds and do it as simply as that, you know. And then if you wanted to take them out, you take them out. It goes back onto the card you put it on from. It's as simple as that.
I must talk to you about that, Stephen.
Yeah, well, if you're going to be selling put options, right?
Yeah.
You might as well do it in a tax efficient manner. There are slight drawbacks to it, Pat, that there is no assignment. You either win or you lose. That's a big difference. Whereas, let's say you got assigned SPY in Interactive Brokers, you're not going to lose any sleep over owning the S&P 500. In this one, you take the hit. You know, let's say it was a bad month, whatever. There's a COVID event or something. You know, you're just going to have to take the hit on it. Now, the argument is then you can just go long on the S&P 500 then at that stage and ride it back up and get your money back. You'll still be down in Interactive Brokers, but I suppose you'll own the underlying asset, you know. So that's the main difference. But other than that, for me, personally, it makes no sense. Like, I was delighted to get the clarification because the last time I checked on this, it wasn't tax-free. That was the advice. But now they've included it as a spread bet. It's essentially viewed as a bet. Obviously, there's no betting tax in Ireland or the UK. So at this moment in time, anyway, that could all change. But right now, it's tax-free.
Very good. Okay.
Yeah, and that's kind of it. So just if you're going traditional route, just to remind people who are outside the UK and Ireland, if you didn't fancy kind of the main futures contract, I think USO is probably the simplest way to do it, to be quite honest with you. And then at least if you got assigned and the backside fell out of oil, you could just hold that USO ETF until oil starts coming back up again. My own opinion on oil, if something doesn't make sense, if you're losing money producing something, you're not going to produce it forever. Eventually you're going to give up and the supply dries up. You know, that's just the nature of the game. So, you know, whilst a ceasefire would be very welcome, it would be an initial shock to oil prices, but I would certainly use that as an opportunity to go long, because my view would be then, do you know what? These guys are going to shut up shop for a while and stop producing oil, you know? So that's kind of it for today. That's all I wanted to focus in on. I think this is our next realistic trade. So it was Meta, going to buy Meta stock, going to sell a put option on crude oil, just waiting. I'm just, my cue here is patience. I want to see, and don't forget, today was a lower low again. This low, so we've already created a lower low today. So this won't be traded today, even though it's up 1%. It wouldn't surprise me if this turns around and starts falling again. And my cue would really be, if we start getting in and around the $57 level, I think the premiums are going to be so attractive, it'll be hard to turn down then. So roughly 2 to 4% lower from here is where I'm looking at. Any questions, guys, or is there anything you want me to look at? No, we're all good.
All good, Stephen.
Okay, I'm going to leave it there. So, you know where I am, folks. If you need me, just WhatsApp me or send me a message to the website, okay? Thanks, guys.
Congrats, Tom. Thanking you. Be good.
Cheers. Bye for now. Bye-bye.
Yeah. Bye-bye.